Hey guys, how you doing? In today's video, I want to show you a very simple 5-minute scalping strategy that you can use to hopefully become a very profitable trader. So all you need is a 5-minute chart, and that's it. That's literally all you need. I trade mostly the Nasdaq. Sometimes I trade the ES, but other times, and you can also use this obviously with the crude oil futures or, for example, gold. That's where I know the strategy works with extremely high win rates. So feel free to test it out for yourself because this just works. It's that simple. So what are we looking for? Every time we want to trade with this strategy, we are looking for one market condition, and that is a range. It doesn't matter what happened previously. It doesn't matter what happens afterwards. It doesn't matter. All we want is to get a very small trade. 50 ticks, 100 ticks, 120 ticks. It doesn't really matter. Quick moves right here. Things like this. We want those kinds of trades with extremely high probabilities. And there was actually a trade that unfolded just here a few minutes ago. And I will show you exactly how you can predict trades like these to the downside as well. But I will also show you a simple way of understanding why sometimes the market doesn't turn around, but instead shoots up. Okay. And without further ado, let's get right into it. So the first key principle with this strategy is that you need to find a range. The market needs to trade in a range. Now, what is a range? It's very simple. We can see that we obviously have a trend down here. The market shoots up, 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 up. And for some reason, it stops here. Now, there's actually a reason why it stopped right here, but that's a whole nother topic for another video. For now, we just need to know that this is a range right now. Because what do we see? We can see that now the trend is broken. The trend is broken. So we don't make higher highs and higher lows anymore, which is usually the case in an uptrend. But now we can suddenly see, hey, we make lower highs and lower lows right here. So the uptrend is broken. And now all we wait for is for the market to shoot down. And now we can see it for the very first time. Okay, the market is pulling back, but we're still making lower lows. So the market is still in a downtrend right here. You want to see an uptrend followed by a downtrend, which then turns into a range. Okay, that is the order. Uptrend, downtrend, lower lows, lower highs. And now we can see once more, higher highs. Beautiful, higher lows. Okay, so we seem to be trading now in the range. So we now know this is the upper end of the range. This right here is the lower end of the range. And every time we have this, every time we go from an uptrend to a downtrend to then a range, we can now go ahead and mark out the following levels. We have the high, we have the low, and now it's just a matter of, will the market break out here, or will it turn around and go back into this range? Both things can happen, but this trade is actually super high in predictability, and I will show you exactly why in just a minute. So the basic idea is the market shoots up right here, but for whatever reason, and the market can only go up if there's more demand than supply. Okay, so if more people want to buy than sell, price goes up. Obviously, vice versa. If more people want to sell than buy, price goes down. So here, something shifted. The market shot up all the way. And now the market just didn't want to go up anymore, meaning we didn't have enough buyers, but now instead we had more sellers. So what did the market do? The market went down, obviously. Now, the question is, why did it only go down to this level right here? Well, very simple. Because at this point, we again had more buyers coming in than sellers. So sellers were exhausted. They said, no, I don't have any more contracts to sell. And then the buyers stepped in and said, hey, this is a cheap price. So this will be expensive right here. And this will be cheap. You can also call this a discount or a premium. It doesn't really matter what you call it. But every time you're trading in a range, you have the upper end and the lower end of the range. And here buyers are in control, and here sellers are in control. Now, the universal principle is the market cannot break out of a range if it doesn't have enough fuel to the fire. So think about this. Every time you trade in a range, what do people do here? They go short, right? Okay, and if they go short, what's the other thing they have to do to get out of their position? Well, in order to get out of their position, they need to buy back the contracts they just shorted. So for example, if they shorted 10 contracts up here, which would be a very smart thing to do because the market went down, their stop loss, which is a buy order, is obviously down up here, right? Now, on the other hand, people that bought right here, in order to get out of their position, and let's say they also sold 10 contracts, they bought 10 contracts, I'm sorry, their stop losses will most likely be here, below this range low, right? Or maybe even some people bought here, it doesn't really matter because they saw, hey, this low is holding up right now, beautiful. So this right here is sell liquidity. Now, think about the following situation. You are a trader at Goldman Sachs, a huge bank. Could be a hedge fund, could be an institution, it doesn't really matter. And your job is to build up a position at this level right here. And your job is to build up a position of, let's say, 1,000 contracts. Okay? So what happens? Well, it's very simple actually. If your job is to build up a position of 1,000 contracts, this will actually be a lot simpler right here. The market, you cannot just buy 1,000 contracts at any given point. You just can't, because think about it, what's going to happen. If the market goes down to this level right here, and you go ahead and you buy 1,000 contracts at once, just like that, the market, because you just bought up the entire supply, the market will just shoot up. And if your goal was to build up a position of 1,000 contracts with an average price of, for example, 725, well, you just failed at your job, because your average price is most likely going to be somewhere here at the 770s. So this obviously doesn't work. Okay, it doesn't work. Now the problem is, where can a market participant build up a position of 1,000 contracts, for example? Very simple. He can build up some orders, or he can build up a position here, obviously, here, here. So the average price is now slightly above his goal. But obviously, because there's a bunch of sell liquidity here, so people that want to sell their positions, their contracts, he can build up a huge position down here. So for example, he bought 300 contracts up here for an average price of this level. But now, once the market breaks below this current range low, he can build up a position of 700 more contracts. Okay, and now what happens? A huge market participant just entered with 1,000 contracts, a buy order of 1,000 contracts. That, my friends, is power. That's fuel to the fire, right? 1,000 buy orders down here. And now compare this. The cool thing is, because you can use this both ways. Right now, the market is trading in this range, right? Think about it. Did we have a large market participant, a big player, build up a position down here? No, not yet, because the market didn't go below this range low yet. It didn't. Same on the other side. Did we see someone build up a huge position somewhere up here? No, we didn't, because the market is now just going back and forth. But at no point in this range did we see that someone is building up a larger position by fishing the stops that are either here or here. So, to sum it all up, because it's very simple now, if we are trading in a range and we haven't seen stop fishing yet, that's a clear indication that the range will hold. Meaning, the market traded up, the market traded down, it came back to this level right here, yet we haven't seen any stop fishing here at all. Meaning the chances the market will break out of this range high right here are extremely slim. Extremely slim. Extremely slim. So what do? You go short. And where do you exit your position? Somewhere in the middle of this range. So most likely here. You go short right here. Okay. You place your stop above this range high, obviously. Okay. And then you have a very nice, probably 1-to-1 or 2-to-1 reward to risk trade. Very simple. So every time you trade in a range, all you look out for with this strategy is where's my high, where's my low. And guys, remember, uptrend, downtrend, now we are in a range. Okay, beautiful. And now you just check, did we see some manipulation? Did we already see some? And if the answer is no, you go short here or long here. Now, it might happen that the market now breaks out of this high, and then comes back into the range and goes all the way down here. What is that, guys? That right here is a big market participant building up an order, buying hundreds, if not even thousands of contracts. He is short now. So what is most likely going to happen next once he built up a huge position to the downside? Well, obviously, the market should now break below these lows. And that is the entire strategy. It's very, very simple. And we can take another look. All we have to do is look for what we call a range. And this clearly, obviously, guys, is a range, right? This is a range right here. Downtrend, uptrend, range. So right here, we have our range high and we have our range low, right? Okay, this is our range. And as long as there's no manipulation to the upside or downside, you can trade this back and forth. So you go in long here, you go in short here, and now you see something happens. You've already made two very nice trades. Profit, right? Nice. But now you see the market went below this low. It had this hammer stick candle right here, which is a clear indication of market manipulation and stop fishing. That's what they call it, stop fishing, because all the stops that were below these lows here got fished. A big market participant built up a large position down here. And now the market has enough fuel to the fire to break above these highs, right? So what do? Well, obviously, you get in here long for a break of this high. Okay. Now, in this case, you could either set your stop loss below this level, or if you're extremely risky and you just scalp this, you just go in for a quick trade in and out. Okay. That would be your options. But if your stop loss is right here, like right below the recent lows, or maybe below this low right here, it doesn't really matter. Then a 1-to-1 risk reward trade would be somewhere here. So within a matter of like an hour or two, you would have been out of your position, and you could already see this. That would be a very nice trade, obviously, if you held this and you got out at this level. But that's basically it. And this works in any market, guys. In any market. Look for a range, recent highs, recent lows. Has there been any manipulation yet? If no, you just go for shorts at the tops and longs at the bottom. If yes, then you have a nice breakout trade. And the cool thing is, even if there's manipulation now, so for example, if the market now breaks above this high, this most likely will be a manipulation because the market does not have enough fuel to the fire. It doesn't. So what you can do, you can also trade another setup, which is we have the lows here, we have the highs here. So if the market breaks above these highs, but then turns around, because that right here is called manipulation, guys. This is not a real move. Then you can go short once more here. Once the market goes back into this range. Obviously, stop should be above this high right here. And then you want to go for 1-to-1, 2-to-1 risk to reward ratio. And that's basically it, guys. A very simple 5-minute scalping strategy that you can use whenever you see a range. And like I said, it doesn't matter if you trade the NASDAQ, if you trade oil, it doesn't matter, guys. As long as you are in a range. And this right here is not a range. This is an uptrend right now. This is the first time we broke this uptrend basically. So now we could go into a range very soon. So right now, this strategy is not valid. Here, no. Right here, very first time. Okay, cool. You could have traded that. But let's look for a real range, guys. A real range. That, for example, right here. This is a range, okay? This is a very beautiful range. So what happens? Well, guys, just this should be so obvious to you guys. So obvious. Just to give you an example, okay? All this time here, we had this range, and you got to be careful, obviously, because there's different market sessions and all that good stuff, you know, so you just got to be careful, But whenever you see the market trending down, you obviously don't want to trade this. You don't want to trade this. But whenever you see something like this right here, then you know the market is about to make a move. So for example, we went and had a very nice short trend right here, right? The market just went down, lower lows, lower highs. Here for the very first time, we built up higher highs. The market manipulated this recent high right here. So now we should have enough fuel to the fire to break out of this recent low because we had a market manipulation here. Perfect. And what did we do? We had a very small breakout. Now, the breakout didn't last a whole lot, like wasn't a big breakout. However, in general, this should be enough for you to make a very nice profit because you can trade from the 63.06 all the way to the 62.90s most likely. So 16 ticks. Okay, just with one contract, it's already 160 bucks. With 10 contracts, 1,600 euros or dollars. Doesn't really matter. Beautiful, beautiful, beautiful. A very simple 5-minute scalping strategy that works at any given time of the day as long as you have a range right in front of you. Guys, if you have any questions about this, let me know in the comments. And other than that, I wish you a great day and I'll see you in the next video.